we think the recessionary risks are clearly rising, and central banks are between a rock and a hard place. So the Bank of England is a classic case where they've got rising inflation, tight labour market, and their hands are a little bit tied. Our narrative, we think, will play out over the coming 6 months or so, where central banks will see that trade-off is getting much more difficult to maintain, and that the softness that we saw some softness in Q1, we saw some little degree of banking turmoil. We think the ground has been set for that to easily repeat itself, and that could easily persuade central banks. So if we go back a couple of months, you recall that the Fed was quite mindful of what was happening in the banking sector. In a tightening credit cycle, where you've still got reasonably high inflation and the central bank pursuing that, there's plenty of scope for some little misstep, for some policy error, and we think that'll become very obvious in the coming months as wage inflation moderates already. So I think, the memo is certainly on its way, but it probably hasn't landed quite yet.
Des, in terms of how we read the market, then based on the macro, there's been some reporting from Deutsche that effectively the technicals are in control here. If you look at the S&P 500, it's been more than 3 months since you've seen a pullback of at least 3%. This is one of the longest stretches you've seen this type of behaviour since World War II. So effectively it's telling us we've stepped away from historical transactions that you would see the percentage swings are simply just not there. Why do you think we're so supported? Do you think this is just down to the technicals and we're going to break from that at some point down the track?
But possibly. I mean, so our proprietary indicator would tell us we're in euphoria territory. And, a lot of good news is taken in as good news, a lot of bad news is taken in a sanguine way. And it can take a couple of weeks for us to break out of that. We're in summer season, so volumes tend to be a little bit lower. As you mentioned earlier, protection is quite cheap, so we could easily see that reversing. We're seeing some bidding up in that protection. We haven't seen anything significantly bad on the earnings front, and that probably helps a lot. So bearing in mind we've had a significant step back in earnings estimates in Q1 and Q2, we're probably looking someplace reasonably close to flat in Q3 for the S&P 5, and then a lift in Q4. And I think maybe the market is taking a certain degree of comfort from that. It's also clearly taking a big degree of comfort from just the general macro outlook. We haven't necessarily technically stepped into a recession in the US. We're very slow. But the market is supported by tight labour markets, and the market seems to be taking a lot of comfort from that right now.
You prefer equity to credit. I'm really interested in that, Des, because there's a lot of cheap stocks out there, no doubt about it. If you ignore a lot of the frothy names out there, a lot of stocks that historically don't look that expensive. But is there just going to be a better opportunity? If you're right and recessionary risks are rising and there are problems down the line, why buy now?
I think that the timing is probably the nuance there. So we're in the near term, we certainly would prefer equity to credit, and that's based on some of those points I made on earnings. It's also based to an extent there's revisions coming through on headline sales plus earnings that are supportive. Some of the technicals are supportive, as we've mentioned. As we play out over the rest of the year, though, we could see that picture changing, and we can see that it could be a time for equity investors to either rotate from the US into Europe, or to lean a little bit more into fixed income and cash, probably cash in fact, but some duration. So if we're right that this disinflationary episode gains momentum, at 375, 373 in the 10-year Treasury, you're looking at a reasonably attractive absolute yield. At 475 in the 2-year, with a yield curve going to normalize, that gives you a good bit of scope for the belly of the curve to bring some decent performance into you. So the point on equities is probably more of a tactical point, but certainly as we go through the year, we can see a role for fixed income to play, and that equity picture will become a bit more challenged. Now, in the meantime, investors can move their portfolios around. So bigger overweights in Europe could make a lot of sense. Depending on how the policy picture emerges in the emerging markets, it could also make sense to start to move in that direction as well. So emerging markets have been very cheap for a while. There's big challenges, but if we do get to the end of the rate cycle in a meaningful way, and we get to some of the rate cuts that we expect in a meaningful way, well, then the EM trade could be back on and we could see a big rotation there. So I think The equity book, you will see changes under the bonnet. You'll see changes in the complexion or the composition of it, but I think it will have a choppy run.